Hello, everyone. We are going to get started here. Thank you very much for joining us today regarding our webinar about retail metrics, which can help you manage your inventory better and compete profitably. My name is Dustin O'Reilly from Retail Pro. With me here is Paul Erickson, who is our presenter. He is with Management One, and through a collaboration with Management One, we offer a solution called Retail Pro Planning, which is an open-to-buy software and service, including sales forecasting and inventory planning. So without further ado, I'll pass it to Paul here to get started on this webinar about retail metrics. Thank you very much. Paul?
Thank you, Dustin, and good morning or good afternoon or whatever time of day it may be for everyone out there. This is Paul Erickson. I am Executive Director of Sales and Marketing for Management One and planning Retail Pro planning at retailpro.com. Thanks to everyone that's listening. I hope you enjoyed the presentation. We're going to be talking about some very important key performance indicators, KPIs, for retail. I think we all know that retail is a blend of art and of science, and sometimes you need to go on instinct in retail, and sometimes you just need to look at the numbers. But metrics matter, and they matter for a number of reasons. They help you become more profitable. They help you bring in more sales. They help you control your costs. But what's more, you need to have these numbers in hand to demonstrate how well you're managing your business. Now, metrics, which are often called key performance indicators, can really act like levers in your business. You pull one, several parts of your business react. If you want metrics that will make a real difference, you need to think of them as interrelated, a complete whole that shows how well your business functions. But just which metrics should we look at? I mean, there are literally hundreds in retail to choose from. If we get too myopic, then that'll eat us up. It'll eat up our time and point us maybe in the wrong direction. If we go too broad, we'll miss some glaring issues. So in this webinar, I've distilled it down to just a handful of metrics that I think really do matter to independent retailers today, because most successful companies, most successful retailers operate reward schemes on key objectives of sales, profit, and productivity, KPIs, because they know that what gets rewarded gets done, and if you don't measure it, you can't change it, and if you don't reward change, change will not happen. So the first one is about as basic of KPI or metric as we could possibly imagine, and it is profitability. Now, profitability in retail is different than other businesses. Profitability in business has to do with our inventory. But profitability should answer the obvious question, how much profit am I making? While sales are obviously great to have, the real reason people open up a store is to earn profits. Gross margin lets you know how much profit you're making when buying and selling. But gross profit and cash flow profit are two different things. And at Management One and Retail Pro Planning, we are very, very oriented to cash management for our clients and making sure that the cash profit is there as well as paper profit. Now, we can go back and look at some very basic things from Webster. Webster defines profit as a valuable return, a gain, the excess of the selling price of goods over their cost. But is that enough in retail? You know, profit as is generally understood by most retailers is what you get to take home after the bills are paid. But then why do so many retailers so very often say, my accountant says I'm making a profit, but I still can't pay my bills? What is wrong? Well, apparently, because this is something that is more common than we'd even like to admit, making a profit isn't the entire equation for success in retail. And what is missing? Well, what's missing, obviously, is that we all know that our profits and our cash are in our inventory. And how well we manage that inventory is absolutely everything to our cash management. So let's go through a basic P&L. And let's look at an income statement, and let's say this is simply a business that does $1 million in sales, to make it simple, and how that would look like from an accounting perspective. We take a beginning inventory of $250,000 at cost, plus purchases of $700,000 at cost, less our ending inventory of $350,000 at cost, and that's how we come up with, under GAAP accounting principles, $600,000 cost of goods sold. Now we take the sales, subtract the cost of goods, and we get the gross profit of $400,000. We take our gross profit less expenses of $350,000, and we get our net profit of $50,000. You were probably wondering, I wasn't expecting an income statement tutorial on this webinar. But this is important because it's a key metric. Because in this particular scenario, this store is profitable. We have a net profit at the end of the year of $50,000. Then we pay taxes on it. But what it doesn't tell us is the cash, because your bank account on the same information I just gave you on the P&L, but from looking at it from purely a cash perspective, cash in, cash out, purchases were $700,000. Those expenses, if you recall, were $350,000. Our cash in on our sales were $1 million. So our total cash out was $1,050,000, cash in $1 million, and in the exact same store that made $50,000 that year, we were upside down in terms of payables by $50,000. So clearly, the profit metric on someone's P&L isn't always looking at the correct information. Because if you are buying more merchandise than you should, for example, in this particular case on $1 million store, purchasing $700,000 was probably at least $100,000 overbought, which caused the inventory to build up at the end of the year, and everything they counted was in profit. And so we were showing a $50,000 profit when in reality, that profit hadn't been made yet. That merchandise hadn't been sold yet, and we were $50,000 upside down. So the very, very first important metric is simply profitability at its basic within retail, and understanding how retail on your P&L can mislead you in terms of how well you're doing. And a better way to look is follow the cash, because the new financial reality in retail today, not only in North America but all over the world, is cash flow is king. We must have a positive cash flow in order to be not only profitable, of course, but also to grow. And if we do not have a positive cash flow, and if we are having certain problems with profitability, then we have to look at the most basic metric of all, inventory. Because inventory is the heart of a retail store. You know, at Retail Pro Planning and Management One, we talk to retailers every day. I travel throughout the world, literally, always talking to independent retailers all over the globe. And it's not uncommon, depending on the vertical that I'm talking to talk to a retailer that is getting barely more than 2 turns a year on their inventory. And 2 turns a year of inventory, it means that that retailer is carrying 6 months or more of unsold product at any given period of time over the last 12 months. And that is the cause of cash flow problems, and that can be the cause of retail failures. So if 6 months worth of inventory is too much for a typical retail store, what's the right amount? And how do we determine the right amount of inventory? What is the metric that determines how much we should have, how much inventory we should have at any given period of time in any given classification and store in your business? How is that determined? Well, we'll do a quick little, I guess, metaphor is a way to talk about it in terms of, let's say I have a pen store. All I sell in my store is pens. And I know for a fact that this month I've got a really good forecasting tool, and the forecast says I'm going to sell 12 pens this month. So based on that, and if I know I'm going to sell 12 pens, how many pens should I keep in stock to meet that demand? Well, when I give this at seminars around North America or the globe, I get a number of different responses. Some people will say 36, some people will say 12, somebody will say 1, just reorder it a lot. You get any number of responses. But, you know, I often say, well, I guess if we're only going to sell 12, all we need is 12, seminar's over. But what if the pen comes in 12 colors? And every single customer that comes into my store this month is going to be emotionally attached to one color. I just don't know which one. So now how many do I need? Well, to cover my bases, I should have 144, right? 12 pens times 12 colors. Oh, and I forgot to tell you that the other part is the pen comes in a longer length and a shorter length, and each length comes in 12 colors. So based on that, on those two sizes, how many do I need? Well, to cover all my bases, I should have 288. How many am I going to sell? 12. That is the aha moment. That is the origin of all inventory control problems. We don't need 288 to sell 12. That's called just in case inventory management, not just in time. How do we tell how many pens we should have right now? What is the parameters? There's lots of books on this. You could look at lead time for reorders and turnover and how fast we can get merchandise and how often we get into the market and the readily available supply to be shipped into our store and how long. You can go on, but essentially we can distill all of that down to one word. And this word might be the most important word in inventory management. This word is probably more important than even margin itself. And that word is time. How long is it going to take us to sell the inventory? When I ask retailers, really good retailers, retailers that understand inventory management, when I ask them a simple question, how much inventory do you have right now? Well, a lot of retailers might say, give me that in cost dollars or retail dollars or units or SKUs or items, dozens. I mean, but when I ask that to really good retailers, what they generally say is, I usually try to keep about a 2.5-month supply or a 10-week supply or a 13-week supply. That will vary based on the time of the year if you're in a seasonal business. But they are always looking at their inventory investment in terms of how soon they will get their money returned back. Time. Time is a key metric. Let's say you're in the women's fashion business. 90% of all sales revenue come from inventory less than 10 weeks old. That's a metric. That is a fact. That is a study that's been done repeatedly over decades, and it always holds true. All sales, by the way, that includes on sale as well as full price. 90%. Your inventory in fashion is much more perishable than I think a lot of independent retailers realize. If we know that your shelf life is 10 weeks, time, that can determine inventory levels based on, say, a 5-week turn. So we should keep about 2.5 times inventory to sales on the average. That is a metric on how much inventory you should keep, and that's going to be based on time and time of the year. Because inventory turnover is a key metric of how well merchandise is performing at retail. And the thing about inventory rotation or inventory turnover in a retail store, it does not appear on your P&L. The interesting thing about inventory turnover, or really what I'm talking about is time, is that accounting does not factor in the element of time. But when I talk about inventory turnover, and when retailers look at it, they talk about ratios, 2.0, 2.5, 3.0, 1.8. And I don't like ratios because, quite frankly, ratios are sound like banking to me. I prefer retail words. And one retail word that I like is week supply because it's about time. So let's just take that 2-turn example that I've been talking about, and let's turn that into time. 2 turns equals 26 weeks. You can take the amount of weeks in a year divided by your turn rate, and that is the length of stay on the average merchandise is in your stores. So on a 26-week supply, it takes us 26 weeks to sell an item. Today's October 10th. So today we receive merchandise, and if we're on a 2-time turn rate, on the average, that merchandise will not be gone. Not this month, not in November, not in December, not in January, not in February, not in March, but you will sell your inventory on April 10th. April 10th from today, that is 2 turns. Now, this is a key metric because we need to put a dollar figure to time relative to selling stock. Increased turns increase your cash flow. An improvement of only 1 week in annual sell-through increases cash flow by approximately 1% of annual sales. This is based on cost of goods sold of 55%. 1 week, 1%. So if your store and let's say you have a $5 million store or group of stores that do $5 million annually, every week is $50,000. So if you were at 2 weeks, and in the first year, we make every effort to speed that up to just 25 weeks. In other words, we get that item in today, but it sells not on April 10th, but on April 3rd, and our turn goes from 2.0 to 2.08. That 1 week in a $5 million business is $50,000, 1% of annual sales, $50,000. If we can just, through good inventory management, get it to 24 weeks, which only changes the ratio from 2 to 2.08 to 2.16, that means that we will sell our inventory that comes in today, March 27th. On a $5 million business, now we've improved our cash on hand by $100,000. And we could go through this example all day. We get it to sell on March 20th from today, 2.26, $150,000. Ladies and gentlemen, you can put in your own numbers. But the fact of the matter is that the big money, the big return is not on margin, but is on time. And the faster we can speed that up realistically, so we're not sitting on merchandise that's unproductive, that can mean a very, very handsome return relative to cash flow. And retail econ 101, if we sell the inventory more quickly, we'll sell it at a higher price. It's just like real estate. If your house takes a year to sell, you'll probably have to mark it down. If you sold your house the first week it was on the market, you probably underpriced it. So time is a part of economics and retail economics. But margin is important. And we have a measurement another metric that will combine our gross profit, our gross margin, with time. And that's called GMROI, gross margin, return on investment. I often ask retailers, how many people here are buyers? We have a group of retailers. Everybody that's a buyer raised their hand, and everybody raises their hand, and I tell them, quite frankly, I don't think there are any buyers in retail because I think we are all investment brokers, and that's the way we need to look at it. We are investing money. If you work for someone else and you're a buyer, I suppose, you are actually investing that person's money that he could have or she could have invested in CDs or real estate or something else, but because they're a retailer, they have entrusted you as their investor or buyer to do a good job. And the answer to if they did a good job, the metric that answers that question is GMROI. How fast did it sell and for what margin? Many years ago, back in the 90s, I was working with a chain of shoe stores on the East Coast of the United States, and their parent company, which was a shoe manufacturer, was purchased by Berkshire Hathaway, which is, of course, owned by Warren Buffett, the greatest investor of all time. And about a month after it happened, I called the president up, and I jokingly asked him if he had had lunch with Warren Buffett, if he had been to Omaha, ha, ha, ha. And he said, "No, I haven't, Paul. But we did have a team from Omaha here in Baltimore last week, and they looked at our bonus plans and how we were bonusing our buyers and our store managers. And after they looked at it, they ripped it up right in front of my eyes, and they said, Mr. Buffett is not going to improve this plan. So they gave me the new plan. And I asked him, what was the plan you were using that they hated so much? And he said, well, we were bonusing our store managers based on increases in gross profit dollars. So in other words, if the gross profit dollars went up 50,000, I'm not sure what the percentage was, but let's say it's 10%, then that manager would get a $5,000 bonus. Now, I was taken aback a little bit because I couldn't understand why Warren Buffett wouldn't want to reward his people based on increases in profit, gross profit, even net profit. But the answer to that question and why they ripped it up in front of them is because they were leaving a very important part of the equation out, which was the amount of capital at risk for that store. Because theoretically, if you don't put in the inventory, you don't put in the capital at risk that was invested in inventory into the equation of bonuses and just profit increases, theoretically, that store could have, brought in $100 million worth of inventory at a $50,000 profit increase, and that buyer or that manager would have been rewarded. despite the fact that it wasn't a very good productive way to use capital on inventory. So they started basing it on GMROI, and it changed the culture there. It changed everything because now they realized very, very quickly that if you're going to be bonus based on gross margin return on investment, then gross margin return on investment is highly influenced by time, by turnover. In the past, they may have ignored slow-selling merchandise because they may have been under the mistaken belief that if we mark it down, it hurts our profit, so we won't mark it down. We'll just put it in the back and it'll collect dust. But that changed. And it changed because of a different view of GMROI. So the question begs, what is a good GMROI? Well, really the answer to that, it depends on every retailer. Each retailer is different. But generally speaking, I think you need to have at least $2 because remember, it's gross margin, not net. You have to pay your expenses. So a minimum of $2, I think, would be for most retailers. Now, GMROI and inventory turnover are the most important measurements for vendors, but it could be for stores as well in retail. It could be anything. And let me explain why. Let's just take, you're a bigger store, you have two vendors. You have vendor A, and vendor A did $500,000 in sales last year. And vendor A had a gross profit of $240,000 or 48%. Now let's just take a look at vendor B. Vendor B did exactly the same amount of business, but its gross profit was $220,000 or 44%. Well, based on looking at this somewhat from a myopic viewpoint, clearly vendor A is the better vendor. There's no question. They did exactly the same revenue, but vendor A produced $20,000 more gross profit dollars. Vendor A wins. But we're not looking at everything. When we add the new metric, the key metric, which is turns, rotations, vendor A, we replaced our inventory twice last year. Vendor B, we did the same amount of business, but we replaced our inventory 4 times. So if you're going to replace the inventory 4 times, doing $500,000, you clearly aren't going to have as much of your capital tied up in unsold inventory. Let's just compare. Vendor A did $240,000, but it was sitting on the average with $130,000 cost inventory, or an ROI of $1.84. But this vendor B, which looks bad, $20,000 less in terms of profit, had a cost inventory of only $70,000, or $3.14. That changes the complexion of how you look at vendor A and vendor B. Think of it as real estate. Let's say my neighbor and I bought our houses at exactly the same time 10 years ago. I paid $130,000. She paid $70,000. 10 years later, we both sold our houses, same month. She sold hers for $220,000. I sold mine for $240,000. If you look at how much she paid for her house and how much I paid and what we sold it at, who's the better investor? My neighbor. Who's the better vendor? Vendor B, because we're going to start looking at things not just from profit, but based on the return on the investment we had to create that profit. Because there is an art and there is a science of investing in inventory. Too often people buy wide and thin, buying incorrect price points, buying just in case, and that's called a buying rut. And there's a lot of other things that they're doing wrong, and they do the same thing over and over and over again. It's like the old definition of insanity, doing the same thing over again and expecting a different result. It could be a bad plan. It could be no plans. It could be overbuying. It could be underbuying. It could be buying from too many vendors. It could be buying duplications. Again, a whole host of reasons. But what it really comes down to is a metric around our inventory budget. Now, I show this screenshot to a lot of retailers because it's a true story. I had a client in the Caribbean years ago, and the buyers for this client, it was about a $50 million business. And the buyers for this client would constantly overbuy. Not a lot, but they'd always overbuy. They'd always feel they needed more. Even though we created an inventory budget based on each individual store in each individual category that bubbled up to an aggregate view, that was a lot of work and a lot of algorithms, a lot of retail intelligence had gone into it. If we said buy $20,000 at cost in sports shirts for delivery in March, April, typically the buyer would go out and buy $24,000. Or $50,000 in dresses in May, June, the buyer would go out and buy $65,000. Wasn't a lot overbought, but it was overbought to the point where it was affecting our cash flow and it was affecting our profitability because of excessive markdowns on excess inventory. So the only way we could get through to these people that we were serious about that number is that we brought them into the conference room. The owner's office was right next to the conference room, and we created a visual. We said, in the office is a safe, and it's the owner's safe, and he has $1 million in that safe. And when we give you, in cash, and when we give you a budget for $20,000, what we're really telling you is to go in, here's the combination, today's combination of the safe, and take $20,000 out and invest that in inventory. And when we tell you to take $20,000 out and you take $24,000 out, what would you call that? Well, there was silence in the room, because by any definition of what we would call that is stealing. Now, they weren't stealing it and putting it in their pocket, but they were stealing profits from the business. And it had to stop, and we had to give them a visual for them to understand why, and it's important, why an open to buy and budgeting in retail is the ultimate metric on how you improve your business. What exactly is open to buy, by the way? I always tell retailers that obviously it's a financial budget, but really it's the first step. It's the first step in a process of managing our inventory better. It's the first step to get better control of inventory, because the first part of the cycle is the purchasing, is the investing, and guidance on how much to buy. Sometimes next month, sometimes at once, sometimes 6 months from now, sometimes even 9 months from now. That is the first step, because if we're under or over buying, we're going to be always at a disadvantage. This open to buy is benchmarking. It's creating benchmarks for evaluating progress. And it's important to understand it is not an assortment plan, but it is a financial tool. Sometimes when I talk about open to buy to retailers, I'd rather talk to the CFO, because he is in charge of managing the cash, managing the assets of the business. And that is essentially what open to buy can help him do. Now, open to buy springs from basically some real basics of retail, which I often call patterns. Because one of the things about retail that's really kind of interesting with it, maybe we've never thought of, is that our business is all about patterns. And these patterns are created essentially by events. These are the events that our customers have, events that our customers have in their lives. And these are unique sales patterns. And what's really nice is that they are cyclical. They happen every year. Therefore, they're predictable. We can predict them. We can project for them. We can then use that as the basis for building an open to buy. So what are the patterns that I'm talking about? Well, I live in Minnesota, and that's an event here in Minnesota that all too sadly is not far away, which is it's going to be winter. And of course, the snowfall drives people, when they can get out of their homes, to the stores to buy boots and parkas and shovels and all kinds of winter things that this event drives consumer shopping patterns. The exact same thing is true on the other side. Spring, when we get warm weather, people are motivated to buy swimwear and shorts and sandals and things like that. Christmas, of course, is there every year. We know that's coming as a shopping pattern. There's Mother's Day. If you sell on universities, homecoming, game days, if you're a pro sports or college sports team, the days of the games are very, very important to know home game schedule in terms of planning. Vacations, back to school, birthdays, home improvement, and yes, even Black Friday. That is an event that happens every year at exactly the same time. And so what good retailers do is they build their merchandise plan around these events. And so let's just do it real quick, if you will. This could be a sales curve, and you see that most of the sales are happening here in this store, in this part of the country, April, May, June, July, and drop off as the weather changes into fall. So this could be swimwear. And if this was in Minnesota, where I am, this could be outerwear, where we're not doing a lot of business in the spring, summer, but it picks up in the fall. And then this could be boots, and that could be shorts, and this could be another category, and that's a different classification, sells differently. And there's another one, and there's another sales curve, and there's another sales curve. And essentially, when you put it all together in terms of your store in these customer demand lines that you see, that's what it looks like. I asked someone, what is that you're looking at right now? And they looked at me and they said, spaghetti, which I guess it did kind of look like spaghetti, but we're trying to make sense out of spaghetti. And that's what we do at Retail Pro Planning. We forecast, and we're forecasting sales, inventories, and receipts for the future, recognizing each of your categories' unique sales patterns, the seasonality, the turnover potential, how to flow in goods, the optimum flow of receipts, and how the model we always try to seek maximizing profitable sales. And because we believe in retail planning at a lower level, in other words, not at an aggregate view, but each classification in each of your stores should be viewed as an individual profit center. Because that is really the key of what we're trying to do. Every store has, as the categories look, is built to the overall category aggregate. So we have classifications in certain stores that miss business because maybe a vendor did not ship on time. We can look at summary data only, but we cannot see the impact in individual stores and individual classes. Many classifications in our stores might have been under inventoried. Some classifications in certain stores had too much. Reviewing summary history only hides the fact that some stores in your business missed business and how much business was missed. Because in order to maximize profitable sales, the forecast must review historical performance at what we call the lowest level possible to still give it meaning, which is in each individual class in each individual store. The flip side of this issue is also important. In many of our stores, we could have been over-inventoried, which resulted in excessive markdowns. So we need to review that at the classification store level in order to most accurately predict and forecast the future. Because using this common approach to planning, this level of review, without it, it's impossible to really do a good job, and people don't do it because of time and physical constraints. But this is what we do at Retail Pro Planning, and it can make a huge difference in some of the metrics I explained earlier in terms of your bottom line. Because at Retail Pro Planning, the planning part of what we do for you, it thinks like a retailer. It really does. We use a proprietary database to analyze historical sales and historical inventory patterns, but we need to ask questions. Were sales above or below last year? And then were they profitable or were they driven by too many markdowns? Was there enough inventory? Did we miss sales because of under inventory positions in some stores? And if we had enough inventory but we didn't do sales, was the receiving adequate? Was the inventory fresh? Was it new? Because you can have as much inventory as you want, but if it is not fresh, new goods, it's not going to drive profitable sales. Do we need to take markdowns? And should we take markdowns now if there's a problem before it's too late at the end of the season? Is our turnover appropriate? Is it appropriate for that category in that store? Because we set up every store in every category different based on a number of factors, primarily one of them being sales per square foot. If you have a store that does a higher sales per square foot, our turnover should be faster than stores with lower sales per square foot, where we would plan a little more inventory so we look like we're in business but still turn it in an appropriate way. How's the sales trend? Is the sales trend up? Is the sales trend down? And even more importantly, for how long? And if the sales were up, was it in important months where the sales indexes were higher, or was it in lower volume months where the sales trend wouldn't have that much meaning? And should we adjust the forecast? Should it be adjusted? And does our on order match our open to receive? These are just some of the factors that go into a good plan, a good forecast, thinking like a retailer, looking at it at a lower level, looking at more than just last year. And then all future months, every month, should be revised, because we're always looking at trending. And what we do for our clients is it frees up buyer or planners, enabling them to spend more time on value-added duties. Because what we do at Retail Pro Planning is we evaluate every element in the store, and literally hundreds of retail decisions. Some of those I put on the screen, but hundreds of those retail decisions are occurring automatically at all times within the forecasting system. And I wanted to end with that because I think there's no more important metric to talk about than planning, than forecasting. And after all, that is what we do at Retail Pro Planning, is that we can give you the kind of accurate projections to give your buyers so that they know that we're not underbuying or overbuying, have the right amount of inventory at the right time in the right stores at the right price.
Okay, perfect. Well, if anyone has any follow-up questions or would like to speak with Paul or myself one-on-one, feel free to email planning@retailpro.com. Otherwise, we will wrap it up for today, and please keep an eye out for the invite for the December 12th webinar, as well as the email regarding how to access this recording. So thanks again for joining us. Everyone have a great day.